Well, it tends to be a lot. A lot of the companies, and again, when you sort of look at the trends within an index like this, a lot of the companies that were taking on a lot of that debt were the companies that actually have still managed to do incredibly well through this period. And those companies can sustain those levels of debt. I think the really key thing, as we say from here, is those companies that probably can't sustain those levels of debt. It's what they do next, and that's what we're really trying to work out. Is that of those companies, some of them are going to be in this sort of balance sheet repair mode. And I think now the lockdown, the economic crisis we've just seen is really going to start to force the hand of those. And I think we're already starting to see that sort of shift from the favouring the shareholder returns now moving back to favouring bondholders.
Yeah, it's really interesting, Tom, as well. And again, fascinating conversation. I didn't even know about fallen angels in the corporate bond market. I didn't know, I'd never heard of it. I should have done, perhaps, as well. But it's now a class of assets that people say, oh, we can own this one, even though their business models are absolutely devastated by this crisis and beyond for having too much debt as well. We think these ones are okay. We should own this. Is this just an excuse to buy junk at the wrong price?
Well, I mean, a fallen angel is just a company that's gone from an investment grade rating to high yield, and high yield itself is a very worthwhile asset class to invest in for investors. So I don't necessarily believe that but just because they've gone to high yield that means then they're not an investable company at all. But what's really interesting at the moment, we've got all of this enormous focus on the fallen angels and the number of fallen angels and the size of the investment grade and triple B part of the market that's potentially coming into the high yield part of the market. But I think the next story that we're going to be seeing over the next 12, 18, 24 months is a lot of those companies that have had a bit of a shock. It's now about then getting their balance sheet in order, as you say, focusing on bondholder returns. And then you're going to see the opposite of the falling angel. You're starting to see the rising stars coming back, and they can be really great investments from a corporate debt perspective as they improve and get back that investment grade rating.